Hey, what's going on, everybody? Welcome to the Gray Report. Now, if you are a multifamily investor, maybe an aspiring investor, perhaps you're already an industry insider doing this stuff every single day. Well, appreciate you joining us because this is the place that you really want to be every week because we're going to break down everything that happened in the multifamily industry, real estate, in the economy, providing you all the latest research reports, articles, kind of just really the stuff that you need to know to make important decisions in regards to kind of multifamily investing. A lot of great topics. One of the most incredible dynamic markets that I have ever seen kind of just still going on right now. So we're trying to make sense of it, break it down for you. Again, we're going to bring in Matt Bosnagel. He's the Director of Communications and Marketing here at Gray Capital. Let's get into it. Matt, what's going on? Welcome to the Gray Report once again. How's your week going? And what are you thinking about this whole multifamily industry?
It's going great. There's a few things that happened this week, especially the jobs report. But it seems like multifamily is continuing its strength. It's last week we spent some time highlighting some of the long-term potential shifts we might see in the next year or so. And this week has been a strong reminder that there are some persistent aspects of the economy and the multifamily market that will continue amidst these long-term shifts. For the economy, it's the coronavirus. It's not going away anytime soon. And I think with the rise of Delta and other variants continuing to put pressure on the labor market, the year-and-a-half story of the coronavirus is still a new and evolving story worth paying attention to. On the other hand, the multifamily market continues again, its stability and its growth with little to suggest that that things are going to decrease in terms of demand, especially.
Yeah. Well, that's kind of summed up a lot of theme of this week's newsletter, the Gray Report newsletter. Again, guys, if you aren't signed up to receive the Gray Report newsletter, hop on over to graycapitalllc.com/newsletter to receive this free newsletter in your inbox every Thursday morning, 8:30 Eastern. Matt, what you were just touching on in the Gray Report, and this just came out today, just a couple hours prior to us recording this episode, Delta threatens recovery, but multifamily remains stable. So that's really kind of the theme. We're going to be talking about some other great topics. I know that all articles that were featured on the newsletter, we're talking about that Berkadia powerhouse poll that came out, interviewed a lot of different multifamily investors, kind of getting their thoughts on where things are going, what they're focused on right now. We're talking about the jobs report, kind of getting into where we're seeing employment related to the coronavirus, related to the Fed, related to the extended unemployment benefits that just expired recently. We're also going to get into kind of some of what builders are doing, building out in the suburbs, and again, the continued performance of the multifamily sector in the face of adversity and all kinds of craziness. So, but really first, just before we get into any of that, if you have not subscribed to the Gray Capital YouTube channel, do that now and give this video a like. And again, we'd love to hear your comments on whatever we're talking about. And then also one more thing, just before we get into it, Matt, we haven't done this in a while, but just a quick snapshots of rates and markets. I'm not going to go through every single rates. Again, this stuff that covers every week on the newsletter. This is put in your inbox every Thursday morning. I wanted to note, the 10-year Treasury has been moving up a little bit. It's at 1.38%, incredibly still, low historically. But definitely we're off the highs that we saw, kind of back. Really the highs back in April and the real lows back in March of 2020. As you can see in this chart, we're kind of right in the middle of this upper band. So I thought that was interesting, to say the least. But you got to watch that 10-year Treasury, kind of where things are going and where markets are moving. Okay, so let's just get into this Berkadia powerhouse poll. Matt, if you could, I'm curious of what your thoughts on the Berkadia powerhouse poll. What is it?
So this poll it's based on a survey of 179 multifamily professionals at Berkadia. So it's not necessarily empirically based or based on like the raw numbers of rent performance or anything like that, but it still has a lot of these powerful insights into the big concerns and the trends that many multifamily investors are thinking about. And the top trends for multifamily investing are interest rates, inflation, institutional interest, and multifamily demand outpacing supply.
Yeah.
I think that really one characteristic is the availability of capital. It's I take this to mean the enormous availability of capital, given the liquidity that we've seen. And the impact of that availability has really been a lot more competition from people chasing yield. Multifamily transaction volume is expected to increase through the end of 2021. And Class B properties seem to edge out Class A properties in terms of investor interest. Top item, I think, on the investors priority list is actively pursuing acquisitions. The market is still hot and the hunt is on. And if you scroll up there, there is that interesting chart on the affordability, the factors for the affordability housing crisis. And it talks about how modifying tax credit policy, increasing investor prioritization, regulatory changes, local state government intervention, but really it's modifying tax credit policy that seems to be the biggest chunk of solutions that will help to immediately address the housing affordability crisis. So people are paying attention to this, and this is something that we should really expect in the next year or two.
Yeah. Well, and if we remember from last week, really modifying those tax credit,
Yeah.
the LIHTC tax credits was kind of the peak policy initiative from the White House and from the Biden administration. Really getting just increasing the availability of those LIHTC low income housing tax credits, because that's kind of really one of the few mechanisms that we have to build affordable housing in the U.S. Unfortunately, you can't build stuff when you want to rent it out for an affordable price. So are there better solutions? Maybe, but that would certainly make sense. That all right, if this is kind of the only tool we have, let's keep using that tool, not getting into the kind of the good, bad, and the ugly of some of those tax credit programs. So that's interesting.
Especially, I mean, this survey was conducted before the White House had communicated and sent out that memo last week. So I think it's interesting that both of these opinions are aligned, and it hopefully will kind of result in more housing supply. But you never know. It's the government.
Yeah. Yeah, it's the government. Sorry, one other just quick point on the survey that I thought interesting is just some of the institutional pain points in the market right now. One is a lack of deals to purchase, decreasing cap rates, lower risk adjusted returns, and those are really the big ones. Everything else is pretty much in the minority. So it's really lack of deals, trying to find actual deals
and that's how that's how I would characterize it. It seems like there's so much money, so many investors that are getting into the market, and they're all actively pursuing deals. That is their top priority. They're kind of really searching for that. And so that's a lot of competition, and that would seem to result in decreasing cap rates or increasing prices.
Yeah. I know that's a challenge that we've had is, it's not that there aren't properties on the market, but, winning those deals, and there aren't enough deals to go around. More buyers, less sellers. And it'll be interesting. We're already seeing, a big push kind of through the end of the year for people who do want to sell prior to the end of the year, anticipating change in the capital gains tax regime in 2022. But still not enough to cause cap rates to expand at all. If anything, they're only further going down as we are seeing a confirmation of this rental growth, which we're going to get into in just a minute. But first, just on another topic is we had a jobs report that came out last week, and so this Marcus and Millichap research brief on employment, Delta variant stalls service related hiring. Right. Rising wages pose new challenges because, again, rising wages it's a double-edged sword. You want people to make more money, but that's, the cost of labor goes up. But really, people aren't taking the jobs. It'll be interesting now that a lot of these extended unemployment benefits are burning off, if that's going to affect things. But Matt, what are your thoughts? A lot of this is related to the Delta variant, and then this new Mu variant.
Yeah,
Um, it looks like hotels are coming back slower. A lot of these service sector jobs. I mean, people just they're not looking forward to standing on their feet for 10 to 12 hours and make
yeah,
$15 an hour. I was talking to someone in the healthcare field, and you hear about the kind of the nurse shortage and nurses walking out. But he said that's talking to this guy in the hospital space, and he said, yeah, it's the nurses, but it's think about all the other like techs and the people, the cleaners,
yeah,
and all the other people that are making way less than nurses, working similar hours, similar conditions. How do you find those people? How do you get those people motivated to make less than what they could potentially be making on when they had all the extended unemployment benefits? So,
yeah.
and that can be that's
It does.
tough.
It does seem like the kind of characteristic of the economy during the pandemic, especially last year, is continuing. In that the service sector is is not growing or really shrinking. There was zero net jobs uh, created in the leisure and hospitality sector, and that seems to be a loss in and of itself. The and but that means though that industrial has still been doing very well. It needs labor, and there's a lot of people hiring for industrial jobs because people want goods. They're not spending money on the services, and they want goods, and it's creating a little bit of a labor crunch. And I would see some logistics issues associated with it as well.
And I'm just kind of guessing here. I imagine that it's easier to pass some of those costs on to in the manufacturing sector than it is in some of the service sectors. That's my hunch. And so you can probably afford to pay a higher wage in those manufacturing or logistics sectors compared to a business that has much lower margins like a restaurant or some other service
Yeah.
businesses. Again, I don't have any numbers to back that up, but
And
that
then
just
I think that the upshot for all of it, or at least in terms of the multifamily market, kind of is when it comes to what the Fed is going to do and how maybe the Fed will react. And the Fed is reacting to the conditions of the economy, and one of their mandates, as we've explained before, is employment. And they are comfortable with a little bit higher potential for inflation than as long as it brings jobs.
yeah.
So this talk about maybe potentially a taper or maybe higher interest rates or something, that may not be in the cards as much as it was before earlier in the year when things were really kind of going gangbusters.
Yeah. I mean, yeah, because I mean the Fed's mandate is not like low home prices or affordable home prices. Um, it's to for it's price. I mean, I guess it's price stability, but it's overall price stability and maximizing unemployment. And I just think that over their belief is they're not looking at this year and next year. They believe over the next decade or so, it's all going to average out. And they've been like wishing and praying for some elevated growth and a little bit more inflation so they could at least get that average out there, and they could try to get a little bit more employment and see a little bit of actual wage growth.
Yeah.
And so like they're like, we it runs hotter for a couple of years, we don't care. And then even again, it's don't even think about 5 years, 10 years, think over 25 years. If it is true that because of technology and demographics, an aging population, a more mature economy, if the result of that is lower rates of growth, like we see in Western Europe, we see in Japan, then this opportunity to see some higher growth, hopefully this will kind of help us get through the slow growth over the next couple of decades. That's at least the Federal Reserve's, I believe, their mindset. But then it's managing, again, like we talked about last week, the psychology of inflation, because it's not just, okay, there's no consumer input and it's just numbers, and inflation is up and it's down no matter what we do. If again, it's the psychology, if we believe there is more inflation, it's a self-fulfilling prophecy in the sense that we start changing our behavior because prices are going up. We'll start locking things in now, and I've seen that start to shift, maybe from even 6 months ago. Now I'm just talking about the housing market again. people saying, it's so expensive. I'm going to wait 6 months, or I'm going to wait eight months or a year to wait
Yeah.
for things to cool off. Well, things maybe cool off, but prices are up 15%. If they're not coming down. Now I think people are saying, hey, you know what, screw it. If I'm going to buy a house, I got to buy a house. And the more the consensus is home prices will continue to go up. A lot of this is, because there were people last year predicting, massive foreclosures, because of, forbearance, and, we've talked about massive evictions, and none of that's happened. None of that's materialized. And so there are all these people waiting on the sidelines with all this money. They're like, I'm ready to go. And people really, they were counting down the date. It was, April 2021 or whatever the date was, and then it didn't happen. And so now they're sitting there holding that bag of like, what am I going to do with it? Now they're coming around, and so it'll be interesting. Getting back to it's really what's going to happen with the psychology of inflation driving prices. I think the Fed is now probably actively managing that perception, really saying this is just going to be transitory, a little transient event, a little blip, and then we're going to go back into normalcy. I don't know if they would say anything different, even if they were concerned that it was going to be longer than transitory, which a lot of economists believe. But what does that look like? Does that mean like 3% growth as opposed to 1.7 or 2, or we're talking 6 or 8 or 10? And what's too high? Well, what's the level where the Fed can't keep calling it kind of no big deal any longer, and they have to take some drastic action? And that's really the one concern that I could have, is the Fed could just screw things up.
But still, I still think that it is worth. Yes, the interest rates concerns on one hand, but also, the jobs are less than a third of what was expected in this jobs report. So I don't think that the Fed was encouraged by that by any means. And that's a big thing, that's a big pressure to kind of continue.
I think you're right. I mean, it's not encouraged, but I think it depends on what they're being encouraged or, incentivized to do. I think it's given them the freedom to say, okay, look, we're not running too hot yet. We've done all this, and it's not like things are way too hot. If they had full employment or closer to full employment, they could say that, okay, we've met our mandate. Or you would have critics saying, look, you said you're waiting for fuller employment. Everyone's got a job now. What are we waiting for? Now they've got a data point of saying, nope, we can justify continuing the bond buying, keeping interest rates low, because look at the latest job numbers. Because we all know that they would like that if they could, and they believe they can. They want to keep rates as low as they can for as long as they can, to support the economy. And again, it's certainly how bubbles can be created. But I think that they believe that they're going to be able to get away with it for quite some time, and they will for quite some time. It's just a question of when. And again, is it 3 or 5, 7, 10, 15 years? We don't know. We just have to still make kind of the right decisions and go in with eyes wide open. So, okay, Matt, I want to get to this home building report, National Association of Home Builders. They put out this nice little ditty. Give us a breakdown, Matt, because I know there wasn't a lot of conclusions, a lot of facts, numbers, which we like.
It's a little bit drier than maybe some of the other stuff that has a little bit better charts and graphs and some more kind of interpretation. But it is easy to pull out some specifics, especially when it comes to the difference between the multifamily construction going on downtown and the ones going on in the suburban areas. And so we have these numbers, in the suburbs, we've got 31% multifamily quarterly growth. Downtown, negative 10.7 multifamily growth for the second quarter. Now, there was still significant construction downtown, but the growth downtown was anemic compared to the big push to the suburbs. And I think this is one of these persistent factors in the housing market that I kind of referenced before, these kind of persistent trends that may have coincided with a pandemic, but really is it's not an exodus downtown as much as it's a movement of the people, to borrow a song lyric.
Well, don't you think
Yeah,
this has to relate to household formation increasing? Because
exactly.
we're not
Yeah.
seeing like a zero sum type of situation of where like it's a -1 downtown +1 to the suburbs. It's
Hmm.
like +2 to the suburbs +1 downtown, or
Yeah.
zero downtown, or like 0.5 downtown +2 suburbs. Plus,
And,
something like that.
yeah, and I think that it's worth watching because this move to the suburbs, that's billions of dollars that people have laid down to say that basically the areas outside of the urban core are going to continue growing. These suburban areas are going to continue growing, and it's not that it's not that people all of a sudden decided because of the pandemic to move. Yeah, like you said, these are generational shifts that we're talking about, and the things that are under construction, they're not looking at a temporary change in preference. I got to get away for a summer or a year. Or really, they're talking about long-term demand, and they're not going to build something, hopefully, if they don't see that demand 5, 10, 15 years down the line.
Yeah. No, I think that's a really good point. This isn't just people buying second homes. I mean, there's that going on, but this is more of a trend of, again, it's people getting married, having kids, and they're like, I want a like house with a yard. I mean, that's kind of I think what it comes down to, or at least they want to buy a house, and the only place that they're building new houses are in the suburbs. And the suburbs have a lot more amenities. We've talked about this in the past. So the suburbs are no longer just endless neighborhoods with nothing
Yeah.
nearby, and you have to kind of drive into kind of the metro to do anything. Now all these suburbs have their own little like satellite mini CBD downtowns.
And that may be one of the more interesting things about this suburban growth, and is the multifamily presence growing and creating these denser areas
Mhm.
and these really kind of vibrant little downtowns.
Yeah.
And it does have a different feel than the very dense urban core, but multifamily is creating a density that's giving it more character and is allowing people to live maybe more affordably with a little bit more space. Even though it's an apartment, you're getting a lot more space and more affordable housing than
Yeah.
you would maybe downtown.
And often better school districts.
Yeah.
Just kind of the quality of life stuff. People, it's why people like this, like the suburbs. Different strokes for different folks, but all's good. Okay, Matt. We got 3 pieces on the Gray Report, all kind of talking about just continued multifamily performance, continued rent growth. One from Globe Street. We've got another one from Yardi Matrix, a full, I think, second half of the year report. And then a Real Page report. Or is this Yardi report? Is this?
Yeah, the Yardi's just for August,
It's
but
just for August. Okay. Yeah, just
but that
August
one,
2021. You want to start with the Yardi report?
yeah, I think that one kind of helps characterize all of them are a little bit of the same song, but maybe
Yep.
different instruments.
Exactly.
Continued stronger performance. This really puts numbers to the optimism and the amount of investors that are flooding in that we saw from the Berkadia Powerhouse poll. National asking rents are increased by 10.3 in August, which is the first double-digit increase in the history of Yardi Matrix data set. And this is a historic performance for really a historic housing market. Nearly all the metros that Yardi Matrix tracked exhibited positive growth, and you can really see that this trend is not going to go away. And I thought it was interesting. They did note a little bit about the debate over the eviction wave. And it says that based on data collected by the National Multifamily Housing Council's rent payment tracker, a wave of evictions is unlikely, especially for professionally managed units. We're seeing rent payments, 94.7 or very, it's high up there. It's not the 85% that we were seeing, last October or last fall and winter.
I don't think we ever got to in the 80s. I think it was all mid 90s.
You know what? I think you're right. maybe I'll edit that, but it's not. It's definitely nowhere not to be concerned about.
Yeah.
And I think that I think that we may see some evictions, but definitely not a tsunami. And the real story again is the continued strength in the housing market and really throughout all metros.
Yep. It's been pretty amazing. I mean, seeing again these headline rent growth numbers are more than we've ever seen, and more than we ever thought would be really feasible. You just again, because we're like underwriting deals every day, and you would for organic rent growth, like anything over like 5% would be typically considered aggressive, unless you really had something to back it up, unless you're like, we're doing something, maybe it's way under market, so you're just going to see that growth. But just to see general, organic growth like that. Now again, and we keep making this point, this is growth on market rents, not lease rents. And so, these higher rents are going to take probably 2 to 4 years to really be absorbed at these newer rent levels, and those market rent levels are going to continue to increase, albeit it has to be at a slower pace than what we're seeing. We can't see 10% for every single year. We may see still elevated above 5% next year. People are saying maybe kind of in like maybe even a 5 to 8% rent growth range, which is be incredible. But what's going to happen? So all of a sudden, rents have grown, 15% over a 2-year period. And you still have these lease rents that are relatively lower, and it's going to take time on renewals to move them up, because you don't typically, not that you couldn't, but most, again, professional landlords, in order to manage occupancy, you don't increase your rents on renewals all the way up to the new market rent. You typically, if someone's at $800 a month and the new market rent is $1,000, you don't raise their rent to $1,000. Maybe it's raised to $825, $850, and then you let them know, okay, the next year maybe we're going to bump you up to $950, still below market, but you're not giving that full rent increase in that first year. You obviously have the evidence saying, look, this is where market is, but from a landlord, you want to maintain occupancy. And if you have that unit, one, there's turnover cost. Two, if you are down for more than a month, or two, all of a sudden you would have had more revenue by keeping that rental occupied for that period. And that's why you really try to get your rent increases on new leases, because it's already vacant. Might as well get it at the market. I'm assuming that rent level isn't preventing you from leasing it out, and that's where that sweet spot is. Of you're at market, you're trying to be as efficient as possible, but at the same time making it still appealing and at the right price point for that prospective resident. So I mean, overall, I mean, strong performance in a lot of markets across the multifamily sector. Again, average national rent growth is over 10% year over year. It's breaking a record. So that is fascinating. And again, it's no real surprise, because again, we track this every day and we're covering it every week. So we're seeing this in real time. But man, 10% national year-over-year rent growth is absolutely incredible. All right, Matt. Well, if someone wanted to receive all these research reports without going across the web, how would somebody do that like efficiently?
Well, you got to go to www.greatcapitalllc.com/newsletter. You can sign up.
It's the only way to do it. Now there's another trick though. So greatreport.com got a lot of this stuff updated daily. It's not as curated and all put together like the newsletter, I'd say. I mean, I think you have to do both. But so if you're going to do two things today, bookmark greatreport.com and sign up for the Gray Report newsletter. Just do those things. You don't have to subscribe. Give this channel or subscribe to the channel. Give this video a like. Don't leave a comment. Don't just go sign up for the newsletter. It's what you want. It's what you want to do.
Well, that's reverse psychology. Now you're going to get a lot of comments.
Don't Don't comment. Okay. So awesome. We will be back next Thursday for another edition of the Great Report, everything that happened in the multifamily industry. We've got a couple of really cool videos that we've got coming out, some cool interviews, folks that we want you to hear from. So stay tuned from that. And, if you're a accredited investor and you want to learn about multifamily investing, GrayCapitalLLC.com is a good place to go over to start doing that. Sign up for our investment club. So, all right, my name is Spencer Gray, president of Gray Capital. Matt, again, the director of communications and marketing here at Gray Capital as well. Thank you for watching this video. Matt, thank you for being on again and putting together the newsletter. Again, top class stuff. All right, everybody, we will see you next week on the Gray Report.